Okay. All right. So I'm going to go ahead and share my screen. I have the questions, so I have them that I'm going to put on the screen. So I can
Same questions as we discussed, right?
same exact questions. I just
All right, good. I don't want you to trick me or nothing.
no, no.
You can trick me. You can try. Go ahead.
No, the exact same questions. Okay, so I've put your contact info, your email, as well as your cell phone number in case any of our investors want to work with you
That's
for.
great. Yep.
Okay,
And
so
they could call me anytime, just so you know, and whatever concerns they have regarding the properties and stuff. Just that's fine.
perfect. So our first and most common question that we are asked is whether they should set up an LLC to invest in multifamily properties, and what are the
Okay.
benefits
Yes.
they do create in
I,
that.
okay. I'll tell you. I think it's mandatory to set up their own LLC for the investment properties. Number one, to protect you from liability on your personal assets, retirement, 401k, stuff like that. It can only you can only touch what's in the LLC. So, in other words, if this had a portion of ownership of whatever the entity is, that's all they could touch, God forbid. Number two, depending upon how we set it up, might be able to work around the passive activity laws. And that's something I'm not going to touch on now because even though, if there's different ways to discuss it. So if anybody's interested in it, we could discuss it. But most of the time, if the K1 is classified as rental income or expense, it's subject to passive activity limitation laws. Okay.
Got it. Got it. Okay. That is our most common question. Question number one. This is a very specific question. One of our investors, working with their accountant, they submitted the K1 that they received for Rockridge, and it shows a loss amounting to $6,359. This loss has been entered by their accountant on line 1B, part of 1 of Form 8582. And he says in part 2, line 6 and 7, it shows that if the modified adjusted gross income is more than $150,000, then the loss we can take is 0. So that's his concern. Then on Schedule E, Part 2, line 28, Section I, there is no loss allowed. So he wanted to
Correct.
know if that was correct.
It is. It is correct. And that's where passive activity limitations come in as a benchmark of 150 married filing jointly. If you were single, or it was 75,000. See, one thing I want to mention here, so everybody is aware, is that the IRS codes. There's a lot of different types of income, and the IRS has different coding and laws for all different types of income, such as passive activity income, earned income, investment income, capital gain income, etc. We could go on. And each classification of income is subject to different laws with different tax liability percentages. So in this case, based on passive activity limitations, that is absolutely correct that the benchmark is 150. Your Schedule E will show a 0 as a loss, and then it gets carried to your 8582, which is the recap to see if the passive activity is required, that you can take it, and then it'll show 0 if you're not. Or if it is, it'll show you the loss. Sometimes part of the loss is accepted, sometimes the whole loss, sometimes no loss. And that's where it appears on 8582 form. And Schedule E just shows the loss, and then the 0 if it's not applicable.
So this may be my limited understanding, but does this mean that they are allowed to carry that loss forward to?
It depends. It depends how everything else fits into play on their personal taxes. It depends. It's if it's not accepted, okay, depending upon what their tax situation is, it's possible that it gets carried forward.
Okay. Okay, got it.
I mean, there's no definitive answers, is what I'm saying, but
it depends on how their taxes are done, and
yep.
you'd have to talk to them more detail. And if somebody's
Right.
with you, that would be something you just take into account and work together to figure out. Because there's more to it than just the passive activity loss. It's how the business is set up, meaning the LLC that they own, how the company is set up. It depends on what I'm hearing
Yeah,
is.
you can. Yeah, mostly. I mean, you can carry it forward. So you really, but here's the deal: you could keep carrying it forward, and it builds up a bank. But the only time it's going to be able to take it is if you fall below the benchmark. And how much you fall below the benchmark, it'll depend on what's allowed that year. Okay, assuming all tax laws stay the same. So, that's it.
Okay, got it. So, question number 2. How can I shelter the profits I made from syndicated deals now as a Class A investor? I'm especially interested in sheltering it when we sell.
Okay, well, what you want to do, excuse me, what you want to do is you don't want to be, here's the deal, you're buying a property. Now, let's just take, for instance, you bought a property 6-8 months ago. You got to look at the market of how it's going. The market's increasing, and it just so happens it's increasing a lot. The rentals are going up, real estate market's going up. So where I'm getting at is you don't want to reduce your cost basis more like a segregated cost situation than your normal depreciation. Sometimes you might not want to, if you have enough expenses, you might not want to depreciate the property as well because that reduces the cost basis. So later on, when you have a capital gain, now on a different income classification called capital gain income or loss, not passive activity loss or income, later on, it's going to take into consideration the capital gain situation when you sell. So the lower the cost, and then it's worth more that you sell more, the higher you're going to be paying more money on your capital gain because your gain is higher. So you want to try to keep your cost basis as long as the market's going up. Now, if the market was going down, you would do the opposite. You would take extra depreciation, cost segregation, and so forth. But I like to be consistent. And when I'm consistent, it usually works because you could gauge and pivot throughout each year to see how that goes. So you want to start off either depreciating minimal, and I tell this to all my clients, or not depreciate at all if you have enough expenses, which you guys do. And that's the best, easiest way to explain it regarding capital gain and depreciation and cost segregation.
So just to recap what I heard, cost segregation is usually better when the market is going down and the value of the property is going down. When it's appreciating, cost segregation actually is not a benefit.
Correct.
What I also heard is to shelter the profits, there is not sheltering profits. It's capital gains. And
well, when you say sheltering the profits, I'm talking about the capital gain, the future capital gain profit in the ahead, whatever that is. And you want to keep your property for more than a year to get the long-term rate. Short-term is higher. So that's how you shelter your capital gain rate, capital gain tax. Okay, you want to keep your cost basis to a minimum. Okay, except for any you want to take depreciation, but in a consistent manner. As long as the property is going up, which in this case it is. And a lot of times I'll advise clients not to depreciate at all because they know when they're going to sell. We could forecast the market of continuing to increase, and it's just money in the bank if you keep the cost basis the same, rather than reduce the cost basis to increase the capital gain. So I hope I wasn't confusing there.
No, that was good. That was really helpful. That was good. Okay, I'm going to move on to the next question. Question 3. We're moving right along. Oh, I'm going to admit one more.
Okay, I'm here.
We're up to question 3. So we had 2 more people join. So I just want to welcome them. And, I wasn't sure if anyone else was joining. So we went ahead and started a little early. But we are recording and we will be sending the recording out soon. So just want to let everyone know who just joined us. Okay. All right, we're ready for question number 3. We as Class B managers, let's say in this Rockbridge situation, we as Class B managers refinance a property and we return all the equity back to our Class A owners, meaning everything they invested, 100% of it, we give them back. They still have ownership in the property, but they get their initial investment back. So now any dividends that they receive after that refinance and after they've received their initial investment back, is that taxable?
Yes, the dividends will be taxable.
Is that taxed as capital gains or is that taxed? How is that
No,
taxed?
it's taxed as an income. It'll be here's the other thing. On your Schedule K1, your K1 is segregated into many boxes. Each way of income, whether it's passive income, whether it's capital gain income or loss, and in this situation, dividend income will appear on your Schedule K1. So whatever your Schedule K1 is gets carried to your personal return, and that box that's marked tells you where to put it on your personal tax return. Your accountant would know that because we see thousands of them and we read thousands of them. So that's what it'll be. So it's my job to record it as, let's say, dividend income, and then when you guys get your K1s, it'll appear right in that box, dividend income.
So is it better for us as the syndicators, as the managers, to refinance and only refinance to give back 80% of what they initially invested so that they are not taxed for the next couple of years?
Yeah, because then it will be considered a return of capital.
Okay.
So, it's still going to reduce, but it won't be income. So it's however you want to, it's really an internal agreement. Either you agree what to do or so forth. One is income and one's a return of capital. Return of capital is not taxed. Income is taxed. Dividend.
Got it. Okay. All right. So now I understand why sometimes people get 80% of their money back, not 100%. And it's probably to avoid paying tax because, not that they're avoiding
right, and you're getting
tax,
some of your equity back, your capital.
Exactly. They get some of their equity back and they're still getting dividends and they are not taxed on those dividends versus
right. And again, it depends how long you're going to hold the property. It depends how long you're, what you could decide that as X amount each year, or let's give excuse me, on the refi, let's give and I'm just being hypothetical, so let's give everybody half their investment capital back. Let's keep half, and then each year we could do 10% more, and then you're going to get your return on your capital from whatever that dividend is. So there's a million and one ways to structure it. It all depends on all the parties involved.
Got it. Okay, good. All right, question number 4 is, I want to invest more in multifamily syndicate deals. I'm selling a house and planning to move the proceeds into a syndicated investment. Is there a way to avoid paying taxes when selling a house and moving the money to syndicate deals?
No, because we discussed that a 1031 exchange is not, you're not allowed to do that. So there really isn't. Upon disposition or sales, the income and loss has to be reported, and then the tax has to be paid on it.
Okay, and so is this
capital
a
gain
legal question? Like, is this something that they should ask their lawyer, or it's just not?
Yeah, they should. This is more of a legal question, okay? Because if it is it's more of a legal question to see if a 1031 exchange can be done in syndicated investments, okay? If it can't, the only other thing to do is to have other companies offset that income on your personal. See, when you do your personal taxes, everything rolls up, okay? You might be involved in this company. You might be involved, you have a couple of your own. Like, that's why it's always a good idea to have your LLC for what we talked about in the beginning, because there's a lot of things you could run through that as well. And kind of, your own accountant could help you structure it where if you know something's happening, sometimes you're better off to think ahead and set up an entity to do numerous things. So I'm just being vague because it's something you want to talk to your attorney or talk to your own accountant regarding that. But there are ways to structure things, especially if you know, the syndicated investment, the what do you call the selling of an investment is coming up. Sorry.
So when we do syndicated deals, we can do a 1031 exchange between one syndicated deal and the next. Is that correct? We can.
Again, I'm not sure because you'd have to ask. I report the 1031 exchange. I'm not sure what's required to get that done. That's more of a real estate attorney or even a title company. Okay.
Okay, I will check into that. So that's very interesting. So if
you'd want to see if that's an option, definitely.
Because that would be a great savings in terms of rolling those.
Well, you're deferring your gain, and it just gives you more time. The only problem is you got, I think, X amount of days to find another syndicated investment and set that all up. So you have to be aggressive whatever the answer is. And if you're aggressive enough, like today, the inventory is low. So you're going to have a little problem and the clock's ticking. You can't just say, hold up, we got a place, but you have to actually close on a place. I think it's 60 days. Yes. So if I'm not mistaken. So that's a tough thing to do. It's a tough thing to do normally if there's a lot of investment is to close in 60 days, let alone when there's not enough inventory. So my advice would be when you go to get ready to sell your syndicated investment, make sure try to defer that as long as possible until you get your ducks on a row on the other side, so you can kind of go right into one into the other. So, this way you could do it before the 60-day limitation.
So I'm going to ask a question. So if people are able to take that passive activity loss and save it up, if they are able to, is that another way of saving on taxes when they sell their property because they've saved up that passive activity loss, if they are able to?
No. One thing has nothing to do with the other. Passive activity income has to be offset by a benchmark of 150. The other one is a capital gain. You can't mix one with the other.
Okay.
So the only other way to reduce a capital gain besides a 1031 is capital losses. And that would be if you had other investments. Okay, let's say you made, hypothetically speaking, for example, you made $100,000 on the syndicated investment on a K1. Well, then you'd have to have either stock market losses or some other loss that you sold something on your own to offset that $100,000. Because the law reads, okay, that you can only take $3,000 above loss above the sales. So the sales, the gains and the losses, you could offset against each other and take $3,000 if you're married, $1,500 if you're single or married separately. So that's what I'm trying to say. If you made $100,000, you try to come up as many losses. Let's say if you have you have a portfolio in your stock market, and there's some stocks losing and so forth. Well, now's your time. That's the time to get rid of them, okay? Because you need the losses to offset the gains, and then you could always repurchase them down the road. So that's how it works.
Okay, got it. Wow.
Did I confuse? Did I say it okay, or
I think I understand. That was.
Well, tell me your concern. Let me clarify it for you.
No, I'm not concerned. It's just a lot of information. My brain's spinning.
It's a lot of information because again, there's so many classifications for income.
Yes.
Expenses are simple. It's either an expense or a capital expenditure, which is a fixed asset. That's it. Okay. You're either going to write it off as an expense or you're going to amortize or depreciate as a fixed asset. Income is so much more difficult and detailed because every type of income has a classification. And with that classification comes a whole set of tax laws of how to handle it.
Yes.
Okay, and once you handle all these different types of income coming from everywhere, it all rolls up onto your personal return.
So
Okay,
when I
except
heard
if
capital
you're a C
losses,
corporation.
when I heard you say capital losses, I took that to mean a new roof. I thought you meant investment in the property.
No, if you bought a house for $100,000 and then you sold it for 50, you have a capital loss of $50,000. If you bought a stock, same thing. So what I'm trying to say, if you know that your syndicated investment is going to make money, and you have a disposition or sales date posted, then you can look at all your other things on the side that have nothing to do with that syndicated investment and say, okay, I got these losing stocks in the stock market. Let's get rid of them now. I got this old broken down beach house that I spent $200,000. It's worth $100,000. Let's get rid of that now.
Okay.
And then you got by the end of the year. So you got all that stuff coming together, and then the gains, the losses will offset the gains, and you could take $3,000 above whatever the gain is, and that's it.
Got it. I understand now.
Yeah. So you want to, because a lot of people just don't have, this syndicate. A lot of people have a lot of different other things that are considered capital gain or losses that they could get rid of to offset the gains, and that's what the whole thing is. You want to offset your gains.
Okay, I got it. Before we move to question 5, I just want to open it up and ask folks, so far, does anybody have any additional questions to what we already asked? Vish, Salva, Smita, anybody? If not, I'm going to move on to question 5.
No, I'm good. This is great. Very helpful.
Chetna.
Yes, Vish.
Yeah, how are you doing?
Good.
Well, thanks for bringing the tax expert onto this webinar. I appreciate it. Thank you, sir, for your time.
Oh, my pleasure, sir.
Yeah. So my question is basically, as a syndicators, we write off a lot of depreciation in terms of when we're managing the property. Now, how does that pass on to the passive investor?
What it does is it fits into the financial statements or the profit and loss statement of the syndicated property, and the bottom line, whichever it is, profit or loss, gets carried to the K1s of each investor, and that K1 you include in your personal tax return. So it definitely has an effect on the profitability of the company as well, okay, as well as the cost basis. So in other words, it has two effects. You're reducing your profitability of the company, and then you're also reducing your cost basis for future capital gain activity when you go to sell.
Okay. So, yeah, because these are the questions which the passive investors would want to know. And
that's fine. That's what I'm doing this for today. So to clarify a lot of you guys, and you guys are more than welcome to call me directly to go further into certain things.
So my next question is, when we give a K1.
Sorry, Vish. I just want to follow up on the same topic which you just touched upon. So the question is, I'm trying to understand. So you're saying, if let's say I receive a statement K1, right? And for my dividend or as a passive income, Schedule K1, let's say I received 25 grand. And how do I write off the expenses out of the 25K? That's the question.
The expenses, when you get your K1, okay, sir, the expenses have already been written off because the K1 will show you a profit or a loss, whatever the property did, which includes the depreciation. How you write that, you have to put that K1 into your personal tax return and see how it fits with all the laws. And that's something you could ask your accountant when you give them the K1. They should put it. It's very simple. K1, the numbers and the figures of the K1 gets entered into your personal taxes unless another company owns that. Then that K1 will go into the other company's K1, and then the final K1 will come to your personal. Okay, I know it's a little confusing, But that's another reason why you would open up an additional LLC, and that's another reason why a lot of people who own these syndicated investments, have other LLCs that own their percentage instead of their names. Okay, it protects you liability-wise, and there's more write-off maneuverability because you could write off your expenses that pertain to that syndicated investment, and your accountant could, see how that fits into the portfolio there.
Okay. I'm glad that I'm investing through my LLC. Thank you.
Does that make sense? Did I say it properly?
I think I understood, but at least there was the understanding is that, let's say, whatever the syndication is writing off, that much percentage you can write off from your K1. That was a understanding, but I think
by the time the investors get the K1, all the write-offs for the syndication have been already taken, including depreciation and amortization.
Right.
That would be everything, utilities, taxes, my fees, everything, okay? So when you get the K1, that's the end result, the end-all, be-all. Now, if you personally have expenses that you use, like travel to see the property and legal fees and so forth, that's another advantage why you would open up that company to own the syndication investment side, so you could run expenses that are associated with that syndication through that personal company that maybe you and your wife would own, and then that K1 would get carried to your personal return. So every entity has a K1, and it stops when you file your personal returns. Okay, and that's that's how it works.
Okay, so question 5, we're actually going to build right on what Salva just asked, which is the depreciation. On our side, when we have, say, granite countertops or vinyl floor, toilets, new sink, cabinets, any of this is being invested into the property, how do we depreciate these renovations? And I think what you said was it's automatic. You do this when you do the taxes for the property. And then
when I do this for the property, when I do the tax, I didn't mean, sorry to interrupt you, Chet. When I do the taxes, it's a judgment call on my side. And you could do it over 5, 7, 10 years, and you sometimes could take the whole thing. But again, we're getting into a future capital gain situation where you don't want to lower your cost basis too much when the market is rising. If the market is stagnant or decreasing, it's another story. So that's more of an internal call, and we could discuss that when I produce a draft of the taxes and you see what I did and how I took it. At that point is when we could discuss, well, should we take more depreciation? Should we not depreciate it? And we could discuss it at that point, because the best part about that is as time goes on, we get a better idea on what the market's doing. And that's, we have the whole year to view the market, and sometimes a little into the next year because the tax returns aren't due to the following year. So for internal financial statements, to me, it doesn't matter. I always like to see the numbers without it, because don't forget, depreciation and amortization is considered a non-cash item. So you always, like for mortgage purposes, to say when you go refinance, you're always adding that back. So the mortgage companies will look at your bottom line and then add back depreciation and amortization, because they're non-cash items, and make your profitability better. And then for tax purposes, we want to reduce the profitability. That's why we have it, and that lowers the tax liability percentages. So that there's no set thing. It could change every year. We could always pivot, and it's just something that's discussed when I produce the draft of the financials, including depreciation and amortization.
Okay.
Does that answer it?
Yes, and I think this October we'll start with our work on, just to give you a heads up a little early, but we'll start with Aspen Ridge, which is the newest property we just purchased, and we'll go over that. Okay, so let's move on to question 6. And I think this just is actually still part of question 5. Do you calculate the depreciation and don't put in the income expense sheet? Meaning when we do the P&L, Do we add the depreciation or
No, when you do the P&L, I like to see the numbers without it, and then I want to give the numbers back to you with it, and then that just gives us both an idea of, okay, the number for this is X, and now after it came back from Victor, it's Y. Now that just, pops in your head. Now, Vic, why is it this way? Oh, yeah, because I only took 5 years, or I decided not to depreciate that. Well, can we? Sure, let's bring it down. If everybody's in an agreement, absolutely. I just like to use my judgment call to give you a basis, and then you guys are the end-all, be-all, and decide, hey, I work for you, so you tell me you want more, you want less, and we talk about it at that point. But it's nice with my experience to let me do it, and then you guys approve it, and then I'll change it, because whatever you decide, I have to do. So that's the bottom line. But I'm usually pretty good with that because I think about that while I'm doing it. So with my experience, I'm giving you my best answer. But sometimes that doesn't always apply, and you might want more or less, and then by all means, I'm going to change it and send you another draft. If it takes 10 times of changing things, well, that's what it takes. But as long as at the end of the day, all the investors are satisfied, and that's what my main concern is that everybody is happy.
Well, that's all the questions I have, but I'm just going to quickly because our folks missed a few of the questions in the beginning, I'm just going to quickly recap. Here's Vic Verdi's information. I'm going to be sending this document to you, to all our investors, actually, to everybody. We'll be sending this out. We had a question, a specific question one of our investors asked, question number 1. Whoops, this is moving a little too fast. Sorry about that. If you're looking at the screen, apologize, just flipping around here. This is about a K1 that they received on a different property. I don't want to go into it again. You can listen to it on the recording, but I'll just show you some of the questions that were asked. No, it just flips too fast, sorry. How can I shelter the profits I made? Basically, we cannot shelter the profits. There is capital gains and capital losses. I think you did hear that question. Question 3 was, there is a property that we have that we will be refinancing and giving all our investors all their, should we give all their money back or part of their money back? And after talking to Vic, we may do 80% back so that they still don't have to pay tax on their dividends for a short while until they receive 100% of their money back. So that helped us in terms of planning on that property. On Aspen Ridge, which is new, we won't be refinancing that anytime soon, but still a very good question for maybe the next one. Question number 4, one of our investors is selling a house to invest more in multifamily, and they had a question about could they use a 1031, which is more of a legal question than it is an accounting question. So we will save that to ask. Again, I just want to thank you so much, Vic. This was amazing.
Oh, my pleasure.
This was amazing, and we will get this recording out. I think if you're okay with it, I'd love to do this again with you maybe next year, or when you have availability.
I'll tell you what, I'll make you a deal. You could do it any time except during tax season, okay? I'd be more than happy to do it at any time except during tax season, but anybody is more than willing to call me one-on-one, and with any questions, there's no charge, I'd be more than happy to satisfy anything because, I'm real passionate about what I do, and I want to help to the best of my ability, so that's all I'm going to say.
Thank you so much. Thank you, everybody, for getting on the call.
Have a good day.
Vic, I have one question before we leave.
Yep.
Oh,
go ahead.
Yeah, one final question. I don't know whether this is related to taxes or not, but however, let me ask you. Now, I have a couple of investors who want to know, they already have a CPA, but that CPA is not familiar with how the multifamily syndication works and how the K1s, most of my investors already have an existing CPA with whom they work with.
Okay.
And now they're beginning to invest in syndications. Their main question is, should they switch over to a CPA who's more into multifamily, or should they continue with the existing CPA? What is your
I
suggestion?
can't answer that question. I can't answer that. With all due
I can
respect,
answer
sir,
that, yes.
if I did answer it, I'm not being ethical. That's something
Wait,
that
I
they would
can
have to.
answer it. I can answer
Can
it.
I just say so? Wait, let me just finish. I would say they should do their due diligence, like every accountant and person does before they make decisions to the best of their ability. And they're more than welcome to call me with any questions to give me the opportunity to explain and satisfy their requests. But at the end of the day, they have to make that decision. I would never go there. But that's the best I could tell you on that.
I
Good
can tell you just
question,
from us doing taxes with Vic, us doing taxes with other accountants in the past, we've worked with multiple accountants. Even with respect to one of our syndicated properties, we've worked with multiple accountants. And the information that Vic has provided, the knowledge that he provides and the work that he does is very different, way above the work we've seen or done with others. Hands down, I'm being completely straight with you. I would highly recommend.
Very kind.
Yeah, a multifamily, an accountant who really understands apartment complexes specifically. It does make a difference.
Hey, Vic, this
Thank
is
you.
Silva. Where do you live? Where are you located?
Me?
Yeah.
My office is in Fort Lauderdale, Florida.
Okay.
Where do you live?
I live in Dallas.
Okay.
Texas. Yep.
I've been there many times. I have clients all over the United States. But with that, let me go. And I thank everybody very, very much. And again, feel free to call me with any questions or concerns you have. Thank you. Have a good day.
Thanks, Vic.
You too.
Thank you.
Thanks for your time. Hey,
Bye-bye.
thanks, Selva, for attending.
Oh, thank you. Thanks for inviting me.
Right. No problem. Yeah, we'll talk later.
Excellent. Thank you. We had booked him for half an hour. That was a wonderful half an hour. So I really appreciate everybody getting on. And I will send this document out. I'll send this document out to everybody. And it's just really essentially the questions along with the video. As soon as I have the recording comes through, I'll send that as well. Are you there? Can you hear me?
Yep, I can.
How did that go? Was that clear? I have to tell you, he saved so much money for my cousin who's a doctor. Huge. It made a huge difference. So why am I not, why is my video, am I still recording? Oh, I stopped my video. I didn't stop the recording. How do I stop the recording? Pause recording, stop recording. There we go.